In the autumn of 2008, the entire global banking system came within days of collapse. Not a slowdown, not a bad quarter, a genuine collapse. The kind where the money in your account, the pension your parents were counting on, the loan you were about to receive, all of it hangs by a thread. And the strange part is where it all traces back to. Not to a war, not to a natural disaster. It traces back to a single quiet word that almost no one outside of banking understood at the time: subprime. Today, we're going to take that one word apart and follow it all the way to the edge of the cliff. I'll explain every piece simply, one step at a time, because the people who caused this crisis were counting on the fact that you'd never bother to understand it. So, let's understand it. Start with the two kinds of borrowers a bank deals with. A prime borrower is the safe one: good income, stable job, a strong history of paying debts back. When a prime borrower asks for a loan, the bank is fairly confident the money comes back. A subprime borrower is the risky one. Maybe the income is low or unstable. Maybe the credit history is poor. The bank can still lend to this person, but there's a real chance the money doesn't come back. Picture two people. Both want to buy the same house. Let's say $200,000. The first earns $6,000 a month. Comfortable. If life gets hard, they can still make the payment. The second earns $1,500 a month and is buying the exact same $200,000 house. Same loan, completely different risk. The first is prime, the second is subprime. Now, hold on to that difference, because the whole crisis is the story of what happens when a system decides that difference doesn't matter anymore. To understand why banks went insane, you have to understand something most people never learn: how a bank actually makes its money. And it's not what you think. A bank does not simply lend out the cash people deposit. A bank creates money through lending. Here's the simple version, using round American numbers so it's easy to remember. In the American system, a bank has to keep only a small fraction of its money in reserve, historically about 10%. That one rule is the key to everything. It means that for every $10 a bank actually holds, it's allowed to lend out about 100, 10 of its own 90 that it essentially conjures into existence the moment it writes the loan. So the bank lends you $200,000 to buy your house. Most of that money didn't exist before the loan was signed. It was created by the loan. Now, watch the profit. The bank borrows money cheaply at the low interest rate set by the central bank, the Federal Reserve. Then it lends it to you at a higher rate, a mortgage at, say, 6%. The gap between what it pays and what it charges is the bank's profit. And because the bank only had to put up a tiny slice of its own money to create that loan, that profit, measured against the bank's actual cash, is enormous. We're talking returns of 20, 30, 40% a year on the money it truly risked. Say that back to yourself slowly. Every single mortgage a bank writes is a machine that prints extraordinary profit on almost none of the bank's own money. So what does a bank want to do more than anything on earth? Write more loans. Always more loans. That hunger, that is the engine of this entire story. But there's a catch, and the catch is you. As long as you pay your mortgage every month, that loan is a performing loan. It's healthy. The bank looks strong, the regulators are happy, the money keeps flowing. The moment you stop, miss your payments for a few months in a row, that loan is reclassified. Now it's a non-performing loan, a bad loan. And a bad loan is poison to a bank. The regulator steps in and says, that money might never come back, so you must now set aside your own cash to cover the loss. Real money, locked away. So one missed mortgage does double damage. The bank might lose the $200,000 it lent, and it has to freeze a large chunk of its own capital on top of that. Its money stops working. Its lending machine seizes up. This is why, when things went bad, banks became desperate to get rid of bad loans at almost any price. In the crisis, banks were selling non-performing loans for as little as 30 cents on the dollar. Think about that. A bank would rather take 30 cents than keep a loan that might have paid a full dollar, because getting the bad loan off its books unfreezes its capital and lets the money printing machine start running again. Now, one bad loan is manageable, but when bad loans pile up past a certain point, a bank runs out of cash to cover them. It can't lend, it can barely function. That's called a liquidity problem. No ready money to move. Remember that phrase. Liquidity. When it vanishes, everything dies. So here's the problem. Wall Street set out to solve. Banks were sitting on piles of mortgages, some good, some bad, and bad loans were dangerous to hold. What if you could make the bad loans disappear, not by fixing them, by hiding them? This is where the great financial invention of the era comes in, and I want to explain it with something from your grandmother's house. Imagine a hand-knitted wool sweater. It's made of hundreds of separate threads. Some are strong, some are thin and weak, some are bright, some are dull. On their own, a few of those threads are almost worthless. They'd snap if you pulled them. But your grandmother doesn't sell you the threads. She weaves them all together, the strong and the weak, tangled and knitted into one finished garment. And when you hold the finished sweater, you can't tell anymore. You can't see which threads were strong and which were about to break. You just see one warm, solid, beautiful sweater. That is exactly what Wall Street did with mortgages. They took thousands of home loans, the good ones that were being paid and the bad ones that weren't, and they wove them together into a single financial product, a bundle, a mortgage-backed security, the sweater. And once it was woven together, no one could easily see the weak threads inside. This technique wasn't born in the crisis. It was pioneered decades earlier, in the 1980s, by bankers at Lehman Brothers, led by a man named Louis Ranieri, who figured out how to turn boring home mortgages into tradable securities. For years it worked reasonably well. The danger came later, when the weak threads started to outnumber the strong ones, and everyone pretended not to notice. Because here's the final trick that made the sweater sellable to the whole world. To sell it, you needed someone respectable to certify its quality. That job belonged to the ratings agencies, Moody's, Standard & Poor's, Fitch. And to convince them, the banks leaned on complex mathematical models, formulas that claimed to measure exactly how risky the bundle was, and concluded again and again that mixing thousands of loans together somehow made the whole thing safe. The math was elegant, it was also wrong, built on the assumption that all these mortgages would never go bad at the same time, but it gave everyone permission to believe. And so, the ratings agencies stamped these mortgage sweaters with their highest possible grade. Let me explain that grade, because it's the hinge the whole crisis turns on. The best, safest rating a financial product can get is AAA. AAA means as safe as it gets. Governments and rock-solid institutions. Below that is AA, then A, then BBB, and downward into riskier and riskier territory. The reason the rating matters so much is who is allowed to buy what. The most conservative, most important pools of money in the world. Pension funds, insurance companies, the money that holds up retirements, are, by law, only allowed to buy the safest, highest rated products. AAA, AA, nothing risky. So watch what the rating unlocked. The banks took bundles stuffed with subprime mortgages, loans to people who might never pay, and got them stamped AAA. And the instant that stamp went on, the entire ocean of retirement money was allowed to pour in. Pension funds bought them, insurers bought them, cities and towns and foreign banks bought them, all believing they held something ultra safe, when in reality they held a sweater woven partly from threads that were already snapping. And it got worse. Because it worked so well, the banks got greedy with the recipe. At first, a bundle might be mostly good loans with just a few bad ones woven in. Then they started weaving in more bad threads and more, chasing higher profits, creating riskier bundles rated triple B, then taking those and rebundling them into brand new sweaters, which somehow got rated triple A all over again. Bundles made of other bundles. Bad debt wrapped in bad debt, and blessed as safe. For a while, this looked like a miracle machine. And for one simple reason, house prices were climbing 10-20% a year in some places, and rising prices covered every sin. Think about it from the borrower's side. Suppose you bought a house you couldn't really afford. Normally, you'd be in trouble. But if the house jumps 20% in value in a year, you can just sell it, pay off the loan, pocket the profit, and walk away. You barely had to make a payment. So, everyone piled in. People bought houses they didn't need, apartments they'd never live in, purely to flip them for a gain. Money was easy. Prices only went up. And remember those bad loans that used to sell for 30 cents on the dollar? Now, woven into a AAA sweater in a booming market, that same debt was selling for a full dollar or more. The garbage had become gold. On paper. The higher prices climbed, the more the sweaters were worth, the more money flooded in, the more loans the banks wanted to write, which pushed prices higher still. A perfect self-feeding loop. And around it, Wall Street built an entire casino of new instruments to bet on these bundles, which we'll get to in a moment. But the loop had one requirement it could never escape. To keep the machine running, you needed a constant supply of new mortgages, new borrowers, always more. And that is where it turned truly dangerous. By around 2004 and 2005, Wall Street hit a wall. It had bundled up nearly every mortgage in America. The machine was starving. It needed more loans to weave, and there simply weren't enough responsible borrowers left. So, the industry made a decision that seems insane in hindsight, but was perfectly logical inside the loop. If we've run out of good borrowers, let's lower the bar until anyone qualifies. Aggressive lenders, the most famous, was a company called Countrywide, sent an army of brokers out to write loans to almost anyone, and the brokers were paid for volume. The more loans they wrote, the bigger their bonus, no matter who the borrower was, no matter whether the loan could ever be repaid. This produced the most notorious loans of the whole era. In the industry, they had a nickname, Ninja Loans. No income, no job, no assets. A person with no income, no job, and nothing to their name could walk in and be handed hundreds of thousands of dollars to buy a house. And here's the twisted logic of why the banks were happy to do it. They knew many of these loans would go bad, but it didn't matter. Because they just weave the bad threads into a sweater with some good ones, get it stamped AAA, and sell it off to someone else before it fell apart. The risk wasn't theirs. It was the pension funds, the insurers, yours. The machine no longer cared whether loans were repaid. It only cared that loans were written. Now, if the story stopped there, it would already be a disaster. But Wall Street did something that turned the disaster into a catastrophe. It didn't just sell the sweaters, it built a betting parlor on top of them. These bets are called derivatives, financial products whose value simply depends on whether something else succeeds or fails. The most important one was the credit default swap. Strip away the jargon. A credit default swap is an insurance policy on a bundle of mortgages. You pay a small premium, and if the bundle fails, you collect a big payout. Sounds reasonable. Insurance usually is. But here's the poison. You are allowed to buy insurance on a bundle you didn't own. Let me make that concrete. Imagine you could buy fire insurance on your neighbor's house. A house you have nothing to do with. If it burns down, you collect. You lose nothing if it stands. And you win big if it burns. Now ask yourself, what do you suddenly want to happen to that house? That is exactly what these bets became. Investors took out insurance on mortgage bundles they had no stake in. And on a single bundle, there might be 5, 10, 20 separate bets, riding on whether it lived or died. The bets stacked on top of the bets, insurance on insurance, options on the insurance. The result was staggering. The total value of all these bets grew to many times the value of the actual houses underneath. One neighborhood of real homes, buried under a mountain of paper worth far, far more than the homes themselves. All of it borrowed, all of it interconnected. And here is the most cynical move of all. Some of the same banks that were building these mortgage sweaters and selling them as safe were quietly, on the other side, buying insurance that those very same sweaters would fail. Goldman Sachs, most famously, packaged and sold toxic mortgage bundles to its clients, and simultaneously bet that they'd collapse. One emblematic deal, known as Abacus, later became the center of a fraud case brought by American regulators, which Goldman settled for over $500 million. Sit with that. They built the sweater, sold it to you as warm and safe, and took out a policy hoping you'd freeze. Almost no one was reading the fine print. The sweaters were rated AAA. Prices were rising. Everyone was making money. So why look inside? But a handful of people did look inside, and what they found terrified them. The most famous was a doctor turned investor named Michael Burry. Back in 2005, years before the collapse, he did something almost no one on Wall Street bothered to do. He pulled apart the bundles and read the actual mortgages inside them, one by one. And he discovered the truth the ratings hid. A huge share of those loans, 40, 50, 60% in some bundles, were already failing, or were built on borrowers who could never realistically pay. The sweaters weren't mostly good thread with a few weak strands. Many were mostly wrought, with a thin layer of good thread on the outside. Burry did the only rational thing. He bet against them, buying that insurance we just described, betting the whole thing would burn. People thought he was a fool. A few others around Wall Street reached the same conclusion and placed the same bet. Their story was later told in the book and the Academy Award-winning film, The Big Short. At the time, they looked insane. Within 2 years, they looked like the only sane people in the room. By 2006 and 2007, the ground began to shift. House prices, the magic that covered every sin, stopped rising. And once they stopped, the whole loop ran in reverse. Borrowers who were counting on selling for a profit couldn't. They defaulted. The bad trades inside the sweater started snapping all at once. Exactly what the elegant math had sworn would never happen. The central bank tried to help. The Federal Reserve, under its chairman Ben Bernanke, began cutting interest rates again and again, trying to keep money cheap and the system breathing. It wasn't enough. In late 2007, the American stock market touched an all-time high and then began to fall. And it kept falling. Then the giant started to die. In early 2008, Bear Stearns, one of the great investment banks, collapsed and had to be rescued in a fire sale. In September, the largest shock of all, Lehman Brothers, a firm that had stood for over 150 years, ran out of liquidity and filed for bankruptcy. And here is the detail that tells you everything about how broken the system was. Just days before Lehman collapsed, the ratings agency still rated it as a safe investment-grade institution. 48 hours later, it was the largest bankruptcy in American history. The dominoes fell fast. Merrill Lynch was swallowed by Bank of America to survive. Of the great independent investment banks, when the smoke cleared, essentially only two were left standing, Goldman Sachs and Morgan Stanley. And now, finally, we see what liquidity really meant. With no buyers left, all those mortgage sweaters and all those bets became worth nothing. Not less, nothing. There was no one to sell them to at any price. And who was holding them? The pension funds, the insurers. The retirement money that was only ever allowed to buy safe AAA products, now holding paper worth zero, the safest money in the world poisoned by the sweater. Here's the question that should be burning in you. How was any of this legal? Because once, it wasn't. After the Great Depression of the 1930s, the last time greed like this destroyed the economy, America built a wall, a law that separated the two kinds of banking. On one side, ordinary commercial banks that take your deposits and make simple loans, safe, boring, protected. On the other side, investment banks that gamble on risky products, allowed to play but with their own money and their own risk. The two were not allowed to mix. Your savings could not be fed into the casino. That wall held for decades. And then, across the 1980s and 1990s, through a long stretch of deregulation and years of very low interest rates championed by the long-serving Fed chairman Alan Greenspan, that wall was steadily torn down. In 1999, the law separating the two kinds of banking was effectively repealed. Soon after, the new world of derivatives was left almost entirely unregulated. The barrier between your savings and the casino was gone. You could now bet on almost anything, and the institutions holding the nation's money were free to bet right alongside the gamblers. The Depression had taught America this exact lesson once. The lesson had simply been unlearned. By the autumn of 2008, the government faced a choice: let the whole system collapse, which would have been worse than the Great Depression, or step in. The man leading the rescue was the US Treasury Secretary, Hank Paulson, and in a detail almost too perfect to be true. Paulson was the former head of Goldman Sachs. He reached into the taxpayers' pockets and pulled out a rescue program of $700 billion. And notice who got the money. The banks got it. The institutions that built the machine got it. The people who lost their homes did not. The families who couldn't pay their loans did not. The rescue flowed to the top, to the very institutions that created the disaster, on the argument that if the banks fell, everyone fell. There's truth in that argument. If the system had truly collapsed, ordinary people would have suffered even more. But it left a bitter lesson that still shapes the world. The ones who caused it were saved, and the ones who were crushed by it were left to drown. And $700 billion was only the beginning. To keep the system alive, Bernanke's Federal Reserve reached for a new and stranger tool: quantitative easing. Let me explain it plainly, because it matters enormously. Quantitative easing is when the central bank creates brand new money, money that did not exist before, and uses it to buy up assets, including the very toxic bundles no one else would touch. It doesn't spend money it has. It conjures money into being. Whose money is it really? In a sense, it's borrowed from the future, from the economic growth of generations not yet born who will have to make that money mean something. Before the crisis, the Fed held well under $1 trillion in assets. After years of this, through 2008 and then again through the pandemic that followed, that number swelled to several trillion. Enormous quantities of money poured into the world with nothing solid behind it. And that flood of money is a direct ancestor of the inflation that households have been feeling in the years since. The bill for 2008 never really disappeared. It was passed forward. So, let's be clear about who ultimately paid. Almost none of the people who built this crisis ever faced real consequences. A firm or two collapsed, but the executives largely kept their fortunes. Almost no one went to prison. Many of the institutions were rescued with public money. The taxpayer paid, the homeowner paid, the retiree whose pension fund was stuffed with poisoned sweaters paid, the young person who inherited a world of inflated prices and diluted money. They're still paying. And this is the deepest rot in the whole system, the thing you should carry away above all else. When these institutions win, the profits go to them. When they lose, the losses are handed to the public. because they're too big to fail, so the state steps in to save them. Think about what that does to behavior. If you know that no matter how recklessly you gamble, someone will cover your losses. You don't gamble less. You gamble more. Heads, you get rich. Tails, the taxpayer pays. That is not a flaw the system stumbled into. By 2008, it had quietly become the way the system worked. So, what do you actually take from all of this? Let me leave you with 3 lessons the crisis paid for in full. Simple enough to remember and worth more than most financial advice you'll ever hear. First, never buy something you don't understand, no matter how confidently someone else explains it, no matter how impressive the name or the rating. The AAA sweater destroyed the world precisely because millions of people trusted the label instead of looking inside. Second, be extremely careful borrowing large sums to speculate, especially on property you won't live in, unless you truly understand the risk and could survive being wrong. The people who flipped houses on borrowed money were geniuses, right up until they were bankrupt. Third, understand what you're borrowing. Borrow in the currency you actually earn, and know the difference between a rate that's fixed and a rate that can rise, because the payment you can afford today is not always the payment you'll be handed tomorrow. The crisis of 2008 wasn't caused by one villain or one bad loan. It was caused by a system that decided the difference between a safe borrower and a risky one no longer mattered, and then wove that lie into a sweater and sold it to the world. History, as they say, tends to repeat. The least you can do is recognize the pattern the next time someone hands you something warm and beautiful and tells you not to look at the threads.